Lesson 97, we're getting towards the end now of the whole course, and I'm just want to very quickly go over the balance of payments again, and is it a cause for concern, and a trade deficit, and everything else pretty quickly. Right, so balance of payments is made up of these parts here, and we end up with something which we call the current account, which is here. Now the current account, I call it the current account deficit, I can also call it the balance of payments deficit, I can also call it the trade deficit. But these are the different components of the balance of payments, and you may or may not know that the UK's trade deficit is pretty large. It's about 5% of GDP. Now the main reason for that is because in terms of the visible trade, and what I'm going to do in the next lecture is outline, okay, well, how can we move forward in terms of all of these. And I've also done films on the manufacturing sector in the UK and how it may be able to take advantage of the future growth in that area. So here we have visible trade, and then we have invisible trade on here. Now in this part of the balance of payments, we're pretty good at it. This is services, this is education, financial services, insurance services, and this brings us in a lot of money per year. Now the big change in terms of balance of payments is net investment income. Now that is when, so we're here in the UK, and if we invest loads of money abroad, in the rest of the world, which is here, then over time we will get profits will come back to the UK. Now overall the UK has been really good at this in the past, so this figure here has normally been plus 20 billion pounds. But recently we've been sending out more money abroad, so other countries have been investing in the UK, okay, and the profits that they get from our investments have been greater than the profits than we've got from investments abroad. So this area used to be plus 20 billion. Now, if it was, our trade deficit would be minus 60 billion, which would not be quite as big. It would be about minus 3% of GDP rather than 5% of GDP. But right now, that's actually turned around. Now, this has to be financed by, this has to balance, this has to be financed by something else. So basically, if you can't finance this, you have to borrow the money, which creates enormous problems for your economy. But we've been quite lucky in the UK because we've always been pretty good at attracting foreign direct investments. And if Tata comes and invests £10 billion in the UK or whatever, this will pay for part of our trade deficit. We also have a large number of shares. So a lot of foreigners will go out and they'll buy British companies and they'll buy British shares, and this is also paid for our trade deficit without us having to borrow money. However, the problem with this is we're getting a lot of foreign involvement in terms of running our businesses, and in fact some businesses have clearly been sold out, or we have to borrow money. So basically a trade deficit in the long run is unsustainable. And that's why there is now so much importance in the UK in terms of our manufacturing sector. Right, it's absolutely critical that we can get that moving forward. Right, and then this leads on to the subject of economic imbalances in the whole world economy. Now in the UK, our trade deficit is 5% of GDP. The USA trade deficit was 6 to 7% of GDP, which is really large, and it was unsustainable. But dramatic things have happened in America recently, which I never thought would happen, was that they got hold of shale gas, so that's reduced their energy costs. Also, they don't need to import as much energy. It's much cheaper now to manufacture in America, so there's a reshoring process that's occurring. So before, the manufacturing industries used to move abroad, but now they're moving back to America because it's almost better that they're in America rather than being abroad. If we're to look at the whole of Europe, there's a real problem here because Germany has a large trade surplus, which is really the problem of the whole euro. So Germany has a trade surplus, therefore the whole of Europe apart from the UK, if we exclude the UK, the Eurozone also has a slight trade surplus. Therefore, if you have a trade surplus, what should happen is your currency is going to go up slightly, because if your imports are always greater than your exports, at some stage your currency will probably fall. So the euro exchange rate is far higher than it should be. Now obviously Portugal, Italy, Greece and Spain do not have trade surpluses. In fact, Greece and Spain used to have very large trade deficits. So normally if they were independent sovereign states, then their currencies would have gone down and their their currency would have gone down, and their country therefore would have been able to rebalance itself towards exports again. But this hasn't been allowed to occur. On the global level, China has a large trade surplus. I think right now it's about 3% of GDP. So therefore their currency should go up. But they've been buying dollars to reduce their currency. So what's happened, if you look at the Chinese currency, quite clearly, the demand curve for their goods should go up, so therefore their exchange rate should always go up. But what they've been doing, they've been supplying their own currency and they've been buying up dollars on the world market, so they've reduced their exchange rate from there. So we have huge economic imbalances in the world, and this is one of the problems, and that means trade deficits. Finally, foreign direct investment for the UK, well, I think it's absolutely fundamental to the UK. And the one good thing that we're really good at is attracting foreign direct investment, because we are the gateway to Europe. One reason we like it is because it pays for our trade deficit. Okay. The second reason why we like it, if you invest, sets off the multiple accelerator, Tata JLR, £800 million into Wolverhampton, and you go through all of those arguments. It would also obviously help to shift out the AS curve, because we are increasing our productive capacity in the UK, and finally they bring in innovation and new ideas to the UK, which is absolutely critical for ourselves. Lastly, the disadvantage of foreign direct investment is the profits from these companies will go abroad, and that is perhaps one of the reasons why our net investment income is now negative. So at the end of all of this, we've got to look at it. Yes, the trade deficit is a cause for concern for the UK economy, but I wanted to teach you this bit. That's what the balance of payments looks like. The financial account, if this is minus 100 billion, this must be 100 billion pounds. This is where the money comes from. Then we also have the idea on the world level of economic imbalances on the world level. And then here we've also got foreign direct investment on here, and why that is so important for the UK economy. Thank you. Okay, lesson 97. I'm just going to go through this very quickly. Is a trade deficit a cause of concern? Because I would have covered already in a previous lecture, but as I was just talking about the balance of payments and about the manufacturing sector, I just thought I'd bring it in together as a little bit of a whole. Well, once again, in 2013, the UK had a record trade deficit of 5% of GDP, which is pretty large. You can remember the structure of that. And it was the net investment income that was plus £20 billion that is now minus £20 billion. Okay. Now, the first thing that happened, of course, is the exchange rate may fall. There's a good bit of theory here for A-level economic students. You talk through the Marshall-Lerner and the J-curve effect, but this is really called the beauty of floating exchange rate. So the exchange rate will fall because the supply of sterling will be greater than the demand for sterling. And therefore export prices will fall, import prices will rise, and we'll eventually get rid of the trade deficit. But there is a huge problem here of cost push inflation, and also we have an inelastic demand for imports. In particular, we have an inelastic demand for energy, and that's going to create a big problem in terms of the UK economy. All right. However, there may be a way around this, because if the UK, like America, does undertake fracking, then we may be able to get lower energy costs as well. So if we have lower energy costs and we have a low exchange rate, and we're able to increase productivity, which at the moment is very poor, and our wages are not rising very quickly right now in the UK, then suddenly we may find ourselves in the same position that America was in effect, that the manufacturing businesses in the world are moving back to America, and maybe manufacturing may move back to the UK. Right. But anyway, so that is the exchange rate may fall. The UK government is pretty keen on the manufacturing sector. The UK is open for business, made in Britain, created in Britain, designed in Britain. George Osborne, in his speech in 2011, we have low interest rates, we do have low exchange rates, and we also have a low corporation tax, which by next year will be 20%. So the conditions for business right now are pretty big. Okay, we adopt a market-orientated approach to business, but the conditions are pretty suitable for manufacturing to take off. Although, as we know, manufacturing is now only 10% of GDP, whereas in 1992, if we can remember, in 1992 the manufacturing sector was 20% of GDP. Okay, But probably the biggest thing is supply side economics, and in particular labour market flexibility and producing the right skills with our labour. So if we can get the right skills in terms of our labour, then we'll be able to produce more goods, and then we'll be able to take off. And obviously the great big thing about supply side economics is that there is no conflict with that particular supply side policy. And finally, of course, the UK has been very fortunate, maybe because of its supply side policy, that we've been able to attract lots of foreign direct investment. Because we've attracted foreign direct investment into the UK, then we have all those advantages of investment, multiplier accelerator, new skills, etc. But it also pays for our trade deficit. However, if none of these work, you have a real problem. Because the final way of getting rid of a trade deficit is just to reduce AD. And if reduce AD, therefore we'll demand fewer imports. But there's a massive complication there is we must have growth in the UK to pay for our budget deficit. So really, if we can get our exports working in the UK, then you can largely say that we've solved the problem in terms of the UK economy. Thank you.